Most people think the great wealth transfers begin with a stock chart. They do not. They begin when the unit everyone trusts starts losing the privilege that made everything else possible. That is where I think we are now, not at the end of the dollar, not at some cartoonish overnight collapse, where people wake up and discover the entire financial system has been replaced before breakfast. That is not how major systems die. They fade in layers, they lose privilege before they lose visibility, they lose power before they lose branding, they become weaker while still looking official. And that is exactly why average investors miss the shift. They are trained to look for drama. They expect a crisis to announce itself cleanly, a one-day crash, a panic headline, a single policy move that tells everyone at once the old rules are over. Real wealth transfers are much crueler than that. They begin quietly when the pipes beneath the visible system start changing direction. That is what I think is happening now with the dollar, with energy, with trade routes, with supply chains, and with the resources. The next 50 years of technology and industrial competition are going to depend on the public still thinks this is about oil. That is because oil is what they can see. The professionals are watching something else. They are watching what happens when the old reason for holding dollars becomes less absolute, when countries no longer need the same quantity of dollar reserves to survive, when Treasury demand weakens at the margin, when rates become more sensitive, and when the United States realizes it must secure the next generation of strategic resources much closer to home. That is the real story, and if you understand it early enough, it does not merely tell you what to fear. It tells you where the money is going next. Let me start with the old architecture, because you cannot understand the transfer without understanding the machine that created it. For roughly half a century, the dollar enjoyed an advantage that no serious investor could afford to ignore. If the world wanted energy, the world needed dollars. If the world needed dollars, the world needed a place to store dollars. The cleanest place to do that at scale was U.S. government debt. That created extraordinary structural demand for treasuries, which in turn helped keep borrowing costs lower than they otherwise would have been, and allowed the United States to run deficits on terms most countries could only fantasize about. That is the kind of privilege people mistake for permanence. They see a system that worked for decades and assume it must therefore be natural. It was never natural. It was a deal. And like all deals, it lasts only as long as the participating parties still find it useful. Now, the public hears phrases like the end of the petrodollar and imagines something theatrical. They imagine the dollar disappearing. They imagine one press conference, one treaty, one BRICS summit, one overnight shock. That is childish thinking. Systems of this size rarely disappear in one move. What they do instead is become less central, then less necessary, then less trusted at the margin, and only much later less visible. That is the part that matters to portfolios. Because once a system becomes less necessary at the margin, the forced demand that once kept it extraordinarily strong starts easing. That does not mean the dollar vanishes. It means the invisible support becomes less automatic. That is enough to change everything. If fewer countries need to keep quite so many dollars or recycle quite so much of their surplus into treasuries, then treasury prices become more fragile. If treasury prices become more fragile, yields become more sensitive. If yields rise, discounted asset values come under pressure. Financing conditions get tighter, and every capital market in the world begins to feel the change. That is why this is not a theoretical macro story. It is a portfolio story. Your 401k is not outside this. Your equity allocation is not outside this. Your safe bond allocation is not outside this. A currency system in transition is one of the biggest engines of wealth transfer the world ever produces, precisely because so many people assume their portfolios are insulated from the pipes that feed them. They are not. Now, here's where I think people are still looking in the wrong direction. They are watching the Middle East like it is merely an energy theater. They are missing the fact that the United States is playing a broader regional game. If the old global policing model produced expensive commitments and fragile dependence on distant supply systems, then the new strategic impulse is obvious. Pull the critical chain closer. Secure energy closer. Secure minerals closer. Secure manufacturing inputs closer. Turn from empire manager into regional gatekeeper. That is what I mean by great reshoring. Not a slogan, a balance, sheet shift, a capital shift, a geographic repricing of where strategic importance lives. And that is why places many investors treat as irrelevant may become very relevant very quickly. Most people do not know how rich parts of the Caribbean and Latin American sphere are in the exact minerals needed for the next industrial era. They hear about electric vehicles and batteries and data centers and military drones and advanced manufacturing as though these were purely software stories. They are not software stories. They are material stories wearing a software costume. Every one of those systems runs through physical bottlenecks: copper, nickel, cobalt, rare earths. Lithium energy, ports processing capacity, refining capacity, stable transport chains. None of that is optional. You can have all the digital ambition in the world, but if you do not control the physical substrate, you are still dependent. That is the big strategic pivot the market is slowly beginning to price. The old dollar order created one kind of privilege. The weakening of that order creates another opportunity entirely. Whoever controls the next generation of critical real assets, or the businesses that build around them, stands in front of the new money flow. That is where I want to be. Not because it sounds geopolitical, because it is how capital behaves whenever a dominant monetary arrangement starts weakening and a new industrial logic rises underneath it. The United States understands this more clearly than most people appreciate. Look at what it has already done in energy. It has moved from dependency toward dominance. It has become a major energy exporter in ways that would have sounded strange to many investors a generation ago. That matters because it gives the country something it always values most in moments of systemic stress: optionality, optionality in energy, optionality in trade, optionality in regional power, optionality in deciding which supply chains must stay global and which must be pulled back into a safer orbit. Now, extend that logic to minerals, to ports, to nearby jurisdictions that are underdeveloped, mismanaged, politically weak, or simply not yet integrated into the next strategic map, but sit on meaningful deposits of what the industrial future needs. You begin to see the shape of the transfer capital does not need the whole world equally. It needs the choke points, and once the choke points become obvious, the repricing begins. This is where ordinary investors get left behind. They wait until the resources are already on magazine covers. They wait until the mining stories are fashionable. They wait until the infrastructure names have already doubled. They wait until the commodity chart looks obvious. By then the elegant money is gone and the late money arrives just in time to hold someone else's gains through the first serious pullback. That is why frameworks matter so much more than opinions. People keep asking me what I think about this country or that political event, or whether one summit means the end of the dollar or the beginning of the next empire. Those questions are too dramatic to be useful. I prefer a simpler framework. When a currency regime weakens, real assets tend to gain relative importance. When strategic supply chains become less trusted, regional alternatives gain value. When industrial competition intensifies, the inputs become more important than the slogans. And when the system begins directing capital into nearby resource development, the winners are rarely the people who bought the most headlines. They are the people who own the bottlenecks, the shovel sellers, the infrastructure, the processors, the transport links, and the companies with rights to scarce things before everybody else understood the rights mattered. That is the framework. Now, I want to say something that may sound harsh, but it is the practical truth of this whole cycle. If you are sitting in cash, you are not waiting safely. You are waiting to be diluted. If you are sitting in long-duration safe bonds because someone told you that is what respectable people do in uncertain times, you are probably holding the wrong kind of respectability. Because the problem in a weakening currency order is not that your nominal number disappears. The problem is that your nominal number remains intact while everything real you need outruns it. That is the oldest trick in finance, and it works because human beings still react more strongly to visible losses than invisible erosion. They hate seeing a portfolio down 20%. They tolerate losing purchasing power for years without fully admitting it happened. That is why asset owners keep winning these transitions in salary. Only savers keep feeling as though the world became unfair all at once. It did not become unfair all at once. It was unfair the whole time. The monetary system simply stopped hiding it as well. That is why hard assets matter so much here. Gold matters, silver matters, strategic metals matter, energy assets matter, infrastructure tied to regional build-out matters. Real businesses exposed to those flows matter, not because they are magical, because they are closer to the new pricing power than cash is. This is the great misunderstanding around inflation and currency decline. People assume the goal is merely not to lose. That is too defensive. The goal is to own what reprices faster than the currency deteriorates. That is the difference between surviving and compounding. And when you look at the map through that lens, the Caribbean, Latin America, and the wider Western Hemisphere begin to look less like background noise and more like the next layer of strategic capital deployment. You do not need every country to become perfectly run. You do not need every regime change to be clean. You do not need every deposit to be immediately exploitable. You simply need to see where the next decade of policy pressure and capital flows are likely to point. And I believe they point toward regional resource control, regional processing, regional energy reinforcement, and the infrastructure needed to connect all of it. That is why I think the phrase great reshoring matters. It is not merely about factories moving. It is about the hierarchy of strategic trust changing. For decades, the market assumed global reach was enough. Now it is beginning to understand that distance itself is a risk. Distance in energy, distance in minerals, distance in shipping, distance in politics, distance in legal control, distance in military protection. When the cost of that distance rises, capital does what it always does. It starts paying more for proximity. That is the kind of shift that can make people very rich if they recognize it while it still sounds abstract. Now let me talk for a moment about how Wall Street actually deals with periods like this, because the public still romanticizes the wrong things. They imagine professional money managers sit around debating ideology. They do not. They follow flows. They follow volume. They follow where large pools of capital are beginning to move before the headlines turn it into a story. This is one of the biggest advantages professionals have always had. Not intelligence, not morality, not some mystical access to truth. They simply have frameworks and they respect them. They know that currency shifts produce huge transfers. They know that commodity cycles and hard asset cycles start quietly. They know that by the time the public feels emotionally comfortable buying, the easy part of the move has already happened. That is why I place so much emphasis on process. Not because process sounds noble, because process is how you stop becoming exit liquidity for more disciplined money. If you had watched certain metal and mining names early in their re-rating cycles, you would have seen the money arriving long before the average investor understood the why. That is how these moves usually begin. Volume changes, relative strength changes. The charts stop behaving like neglected garbage and start acting as though a new constituency has discovered them. Then the narrative arrives later. The public, of course, tells itself a comforting lie. I did not miss it. I was being prudent. Usually they missed it because nobody ever taught them how capital actually moves. And that, more than anything, is the true scandal in modern finance. People are told to save. They are told to diversify. They are told to think long term. Fine, but they are almost never taught how monetary systems, supply chains, strategic resources, and institutional money flows interact, which means they enter wealth transfers blind and then call the outcome unfair when they realize the winners were playing a game they themselves had never been taught. So let me state the action plan as plainly as I can. First, stop assuming the dollar can weaken only after a dramatic public ceremony. It can weaken in privilege long before it weakens in headlines. Second, stop treating all hard assets as interchangeable. The point is not to buy stuff. The point is to own scarcity and strategic necessity. Gold is monetary scarcity. Certain industrial and battery metals are strategic scarcity. The distinction matters. Third, think regionally. If the next phase is about reshoring, friendshoring, and strategic resource control in the Americas, then businesses with exposure to that build-out matter far more than many global stories people are still chasing out of habit. Fourth, reduce your emotional dependence on cash and long bonds as though they are the only proper form of caution. In a weakening reserve system, those can become the most elegant way to stand still while the world reprices around you. And finally, learn to follow the money earlier, by the time everyone is talking about some region, metal, or supply chain as the next big opportunity. You are no longer early. You are participating in the distribution phase of someone else's patience. That is not where I want to be. I would rather look foolish early than helpless late. That is one of the oldest advantages in investing. Now, let me close with the broader truth, because this is bigger than one island, one conflict, or one commodity. The great wealth transfers of history rarely announce themselves as opportunities. They look like disorder, they look like conflict, they look like policy confusion. They look like one old system losing credibility while a new one has not yet earned a clean name. That is the phase we are in. Now, the old dollar privilege is not vanishing tomorrow, but it is no longer so absolute that you can build a portfolio as though nothing beneath it is shifting. The new game is not about whether the dollar disappears. It is about what gets repriced as the system needs less of it and more of something else, more local energy, more local minerals, more processing, more regional infrastructure, more hard assets, more businesses tied to the physical bottlenecks of the next industrial era. That is where the big money is going. And if you are still positioned as though cash salary and passive trust in old structures are enough, then you are not just unprepared. You are volunteering to fund the transfer. I have no interest in doing that. I would rather own the things the next system cannot function without, because when monetary privilege fades, the winners are rarely the people holding the old promise the longest. They are the people who understood early which real assets the new order would have to bid for no matter what the politician said on television. That is the real end of the petrodollar story, not panic repricing, and most people are nowhere near ready for it. There's another mistake I see people make in transitions like this, and it is subtle enough that intelligent investors fall into it all the time. They keep looking for confirmation in the wrong place. They want the newspaper to tell them the dollar order is over. They want policymakers to admit that the old framework is weakening. They want some giant visible sell-off in treasury markets and some neat televised explanation that connects all the dots for them. That is not how systems of privilege fade. Privilege fades first in the margins. A little less forced demand, a little more local currency trade, a little more regional settlement, a little more pressure on funding costs, a little more sensitivity to who still buys the debt, a little more incentive for the United States to secure the hard stuff directly instead of trusting distant arrangements to remain stable forever. Those little shifts do not feel world-changing at first. That is exactly why they are so powerful. The public waits for a grand ending. The professional studies the incremental erosion, and wealth is usually transferred in the gap between those two behaviors. This is why I do not need the petrodollar to disappear tomorrow to take the repricing seriously. I only need the market to understand one painful increment at a time, that the old automatic demand structure is not as automatic as it used to be. Once that recognition spreads, the search begins for what holds value better than passive dependence on the old privilege. That search is what pushes capital into gold, into strategic metals, into energy infrastructure, into regional build-out, into scarce real assets, and into the companies tied to those flows. And by the time that search becomes obvious to the public, the first and cleanest money has already moved. That is why I keep returning to the same conclusion. This is not about predicting a dramatic collapse. It is about recognizing that even a slow weakening in the old monetary architecture can create a very fast repricing in the assets the next architecture will need most. That is the opportunity. And that is why the investor who keeps waiting for the all clear will probably get exactly that. He will get clarity, he will just get it later at much higher prices. After the best asymmetry has already gone to people who understood the shift before it became emotionally comfortable, that is how the biggest wealth transfers always feel in hindsight. Not mysterious, just early. And that is really the final dividing line. The losing side of a monetary shift keeps asking whether the old world can be saved. The winning side asks what the new world will have to pay up for. That is a radically different posture. One side waits for reassurance. The other side starts accumulating relevance. If you are still thinking only in terms of cash safety, salary security, and mainstream portfolio comfort, then you are still positioned for yesterday's system. Yesterday's system may not vanish on schedule, but it no longer deserves blind trust. The investor who understands that does not need certainty. He needs exposure to what the next decade cannot run without. That is why I would rather be early in hard asset strategic resource plays and regional build-out than late in the old promises. Because when the old privilege weakens, the new scarcity gets expensive very quickly.